Welcome to the BNB Investing Podcast for real estate investors. Fix and flippers and realtors exploring investment options with Airbnbs and short-term rentals through acquisition, leasing, or management to generate consistent monthly revenue. Join us for a chat with experienced and successful short-term rental investors to hear their story of how they got started and created wealth by building scalable businesses. We also explore various service providers and lenders that help make our businesses more efficient and maximize revenue in this awesome sharing economy. Welcome your host, Rich Monroe.
Hey everyone, Rich Monroe here with B&B Investing Group. Thanks for jumping on this week. As usual, B&B Investing Group is working with short-term rental investors as well as realtors that want to learn about short-term rentals and kind of build a scalable model. This is something that we help all investors with. We kind of navigate the three different options, whether you're doing acquisitions, the master lease or rental arbitrage strategy, and then also managing properties for other investors. And so today we're kind of focus on the acquisitions model with short-term rental investing, and have a good friend of mine on today with us, Kenneth Igwe. Thank you so much from Baker Collins and Company. Thanks for jumping on with us this week. Tell us a little bit about yourself, Kenneth.
And first and foremost, thank you for having me, Richard. It's always a pleasure to have these conversations about, investing in real estate, what we do. So very simply, my name again is Kenneth Igwe. I'm the managing director for Baker Collins and Company. We are, originally from Houston, Texas, came here, specifically here being Atlanta, Georgia, back in 1996 for the sole reason of going to college. Proud graduate of Morehouse College and Georgia Tech. Got a master's degree at Morehouse, electrical engineering degree at Georgia Tech. From there, started to fix and flip properties because as much as I love engineering, I loved fixing and flipping better. Wholesaled a couple of projects. Again, this was a couple 20 years ago. So realized that that really wasn't my lane. As a result, I started to kind of get into more things, specifically finance, and really fell in love with the world of finance. Fell in love with it so much so to where I actually decided to go to graduate school, get a master's in finance, and then I became an investment banker. Worked in investment banking for a number of years. Loved the work, loved putting deals together, wasn't a fan of the people that I was working around. So eventually I decided to kind of walk away from investment banking, but I really, really loved the work. And so we decided back in 2015 to start Baker Collins. Baker Collins and Company, we're a commercial lender. We finance residential as well as commercial real estate projects all over the country. On the residential side, we finance renovation loans, new construction loans. We will also finance DSCR loans, otherwise known as rental properties. And today we're going to have a good discussion about short-term rentals, B&B investing. On the commercial side, it really runs the gamut. We finance all vertical, office, retail, multifamily, and industrial. So again, look forward to having this conversation. It's going to be a fun one because you guys are talking about all the things I love, real estate and finance.
All right, very cool, very cool. And you're also an investor yourself as well, right? You have some multifamily units that you have.
Yes, I'm an investor. I own multifamily. I own land. That's my bag. Multifamily land, and also I invest in notes.
All right, very cool. So, quick story before real estate, I actually was very much involved with the debt buying industry, right? So consumer debt mostly, not so much real estate. And so I know that industry well with the ability to buy, notes for a discount, obviously, and then as an investor, kind of earn a return on that. So that's a great business. I still kind of poke around a little bit with it myself. So before we dig into it, on the multifamily side, are all of those long-term rentals, or do you have some short-term rentals in that inventory?
All of them are long-term rentals. So I've got to catch up with you, Rich. So I actually have to have a conversation with you about the short-term rentals, but it's a portfolio that we like the cash flow that we can really know it's coming in every month. With the short-term rentals, that's a market that, although we finance a ton of those deals, admittedly we don't have it in our portfolio, but we are definitely going to do that. I definitely have to connect with you and kind of or more about that as well.
Yeah, no, we've done some pretty successful partnerships with multifamily investors and owners. For those of you jumping on, please throw a quick yes in the comments for me, just to let me know that you can hear us okay. We're also going to take some questions as well, so feel free to throw any questions out as we dig into this. But real quick before we get started, Kenneth, so we've had 22 unit buildings, for example, where they had a recent rehab. They were experiencing some issues with vacancies, and so they had probably 8 of the 22 units that were sitting empty. And so when we partner with folks, we can come in and furnish and stage and set those 8 units up. We can structure it as a residual share agreement, or we can do it as a master lease. And it's a good way to quickly convert low performing developments into 100% occupancy with the short-term rental model. And so we've specialized in that for many years, and it's a little bit of a science because you have to kind of navigate the coexistence of long-term with short-term, and making sure that you don't have a disruption there. And so we use noise detection devices and other technology to kind of manage through that as well. But would love to chat with you about that later and see if there's an opportunity there. But let's talk.
If I can interject, we actually suggested that strategy to a client of ours that was doing it, that owned a 10-unit multifamily project in Myrtle Beach, South Carolina. And they executed that exactly how you discussed it, just shared with us, and it worked out perfectly because they were kind of in that transition from occupancy and things of that sort, but it just worked out really well. So 100% those things work out very well.
Yeah, very cool. Very cool. And so most of our members that are looking into the acquisition strategy, most of the time they're already doing fix and flipping, so they're familiar with commercial lending to a certain point, but at a certain degree. But a lot of us that have been doing wholesaling and fix and flipping, we're kind of in and out of the deal. We do our loan and we're done. So would love to kind of just hear from your perspective. What are the options if you're going to be looking at buying properties to do this on a longer term? Buy and hold, and whether you're buying distress and then refinancing later, what are the different options there for folks?
So there's a couple of options, and it just depends on the borrower's investment strategy. So if you're a value-add investor, if you're an individual who's going to buy a property, renovate it, and then you plan on keeping that property, we'll do an acquisition and renovation loan. With that acquisition and renovation loan, we're going to give you up to 85% of the total cost of the project. You'll bring 15% as a down payment. We finance remaining 85%, where we're going to finance 100% of the construction budget. And once you have a certificate of occupancy, or preferably once the property is fully complete, now we can refinance that short-term bridge loan that we've created for you into a more permanent loan at a much lower interest rate that allows you to really cash flow. And so that's one option. Being able to buy, essentially you're executing the BRRRR strategy, but instead of using a long-term rental, you're putting a short-term rental in there. And with short-term rentals, B&B investing, that is, when many people think, I think we were discussing this before we got the call, Rich, there's a bigger universe of short-term rentals. You've got, obviously, Airbnb dominates the space. But when we speak about short-term rentals, we're also considering other platforms such as Furnish Finder, and we're also considering other platforms. We have clients who buy short-term rentals when they rent it out to folks who have just had maybe a life change, or they decided that they want to renovate their home and they want to live in a home and not an apartment. So I want folks to really understand that there's a bigger universe there. But one of the things that we like to do is just really get to understand what exactly will the market rent be for that particular property, and then we compare it to what you're able to obtain as far as cash flow or as far as daily rates from the short-term rental. And so we'll do an analysis to see which one kind of works best in order to get that to you as well. Second option is if the property's already turnkey. Now, if it's already turnkey, it's a simpler process. You're just going to go in there and you're going to buy the property. We're still going to take a look at the market rent. Whenever you're discussing any type of lending options with a lender for a permanent loan, we are always going to take a look at the market rent, but we also will take in consideration what you're able to obtain and what you're able to procure on a daily rate from your short-term rental platform. And even better, if you're able to buy a property that already has short-term rental history or short-term rental income, that is like music to our ears, because now there's no proof of concept. You've already proven the concept. And we can share, if you can send us over those financials, financing can be extremely attractive if you have those financials, along with a purchase and sales agreement, things of that sort. So those are the things that we.
So in broad strokes, is there like a advantage in underwriting on the short-term rental revenue that's typically going to be 2 to 3 times a long-term rental market rate? Do I get, as a borrower, am I getting some, advantages through the underwriting process as a result of that? Or is it still, because it's kind of not predictable, that you kind of hang your hat more so on the long-term rental market rate?
Yeah, the lending industry is really going to hang our hat. I mean, when I speak about lending, we're going to speak in our industry, right? Lending is a function of risk and leverage, right? Risk, and when we deploy capital, we have to deploy capital in the most efficient manner. And admittedly, the long-term rental is a little bit. Again, this is the opinion of my peers, my colleagues, the folks that we do business with. But the long-term rental is a little bit more of a safer bet. And because it's a safer bet, because those are long-term rentals, fixed rents for however long the borrower has that property for, as opposed to short-term rental where it could be seen or perceived as a little more volatile. Now, granted, the upside is insane, 2 to 3 times more rents. Those are great numbers. But typically, from our industry, we're going to see it as a little bit more riskier. But the pricing is not going to be it's not going to be as drastic of a change as one may think. And so we love short-term rentals. Our industry is a lot more accepting of them. If we were having this conversation, Rich, back in like 2018, 2019, we would have a different conversation, right? Yeah. 2019, 2018, and again, they were completely wrong. But a lot of folks in my industry, a lot of my peers thought that the short-term rental model was, quote unquote, and I've heard this, and this is a technical term, a fad. And what changed that mentality was COVID. And COVID, because of the social distancing and because of the, making certain that you were masked up and things of that sort, it just kind of exploded. And so now it's short-term rentals. When we speak about that, it's a new asset class. So it's here to stay. It's not going anywhere. It's a very, very attractive asset class to so many of us. We love seeing them because we know that they cash flow. But we're also looking for good operators. So it's one thing to have a short-term rental, but it also is, how good of an operator are you? That's why having an income already coming in is always going to be more attractive to a lender when you have that in place. But if you're a good operator, if you're a good manager, if you understand how to turn those units over, how to handle some of your tenants' challenges, how to be able to market effectively, you'll do well, as so many of our investors are doing in the short-term rental space.
Yeah, and so, our historical performance and kind of what we teach our clients in our group is, we're running this like a business. There's probably, 40% of all listings that are professional, either property managers or short-term rental investors, and really truly running it as a business. The other 60% are kind of one-off, mom and pop, one-off listings. And so what tends to happen is, we're going to enter a market with the objective of outperforming the average nightly rates and the average occupancy, typically by 15 to 20% after the first 3 or 4 months. And so, when we come in, the estimates that we typically use are usually going to be very conservative, but our main objective, and we've got historical performance that shows this, that we're going to, outcompete what's currently out there as far as the average market rate going, because we are running this like a business. And so, so when we do acquisitions, we typically will already have historical data, maybe not on that unit that we're purchasing, but in that same market for other units that we've already had up and running. And so when you guys are doing that initial underwriting, are you looking at platforms like AirDNA to forecast revenue? And if so, I've heard that some lenders are kind of applying a haircut or like a discount to those numbers to, again, kind of be conservative.
Yeah, no one, you're spot on. So we do, as it relates to Airbnb, we do check AirDNA daily rates, and in some cases most cases we're going to add a discount to that because, for example, we'll do AirDNA. This property is generating $130 a night in rents. I'm sorry, in daily rates over 30 days. Obviously, the likelihood of someone actually having their property rented out in 30 specific days or 30 consistent days is probably not going to happen. So we apply a 20% haircut to that. Some 20%, even sometimes a 15% haircut to that. So even if they can cash flow at 80 to 85% of that total monthly revenue, that's still a deal for us, right? And if we know, and more than likely they should still be able to cash flow, and not just cash flow, but they should be able to be at in many cases, a 2x scenario because of the fact that they're getting $130, $140 a month. And it also is still relative to what the monthly payments will be, what the PITI would be, payments, taxes, insurance, things of that sort. So we want to make sure that they're cash flowing. We try to be as objective as possible. I love math, and we focus on the math. We want to make sure that if the math works, and we believe that we have a strong borrower, we're going to want to finance that deal.
Got it. Now, I know you had some slides that you wanted to go over with us. Is now a good time to jump into that?
Yeah. So I wanted to kind of share with folks, when we look at deals, for the most part, I always tell folks lending is fairly simple. When you're looking at lending, you really just want to focus on literally, you guys see my slide, let me see this.
Yeah, it may take just a minute to come up.
Okay.
There we go.
So as it relates to renovation loans, lending is fairly simple. I mean, there's literally 4 things that we're going to take a look at, right? We're going to make sure that the project makes sense. Does the project make sense? How do we define the project making sense? We want to make sure that it's a profitable one. So we're going to do our calculations. If there's a renovation loan, we're going to look at what we call loan to cost. We're going to take total cost. We're going to essentially apply a percentage against that. Then we're going to take a look at the completed value or the future value if there's a renovation component attached. Renovation loans, new construction loans, those are riskier loans. And because of the increased risk, those interest rates are going to be a little higher. However, to simplify lending from a commercial lending perspective, we do not look at things such as tax returns. We do not look at things such as employment verification. We do not look at things such as income verification. But this is what a traditional bank is going to look at. A traditional bank, a conventional bank, your Wells Fargo's, your Bank of America's, your Truist banks, they're going to look at and they're going to underwrite your deals in this manner. Number one, they're going to take a look at your credit. They want to make sure that your credit is, hopefully, I believe it's a 580 is the lowest one you can go. Please correct me if I'm wrong on that one. Then they're going to want to take a look at your verifiable income. They're going to want to make sure that you have the means to repay back this loan, either through bank statements or tax returns. One of the two, if not both. Next, they're going to take a look at the as-is value of the property. They're going to want to make certain that you're not overpaying for this asset. Because if you overpay and God forbid they have to take the property back through a foreclosure or a deed in lieu, then they essentially have a piece of an asset that's not worth as much as the loan. And then lastly, they're going to take a look at the property condition. So these are the things that a traditional lender is going to take a look at. Now, if you compare that to what we do, we're a little different. So because we're a commercial lender, a private lender, we look at, number one, the location. We want to make certain that the borrower is buying a property. We prefer for the borrowers to buy properties in more urban markets, more markets where there's a lot more people. But the beautiful thing about Airbnb and B&B investing, we've realized that a lot of our a lot of our clients do extremely well when they're in areas that are beachfront properties and they're in mountain properties. So if it's a B&B property, they do extremely well because they cash flow a lot better as well. We love them. But we're also going to take a look at the strength of the project. Do we believe that the project is going to be a feasible one? Do we believe it's going to be a viable one? Will it be a profitable project? We're going to take a look at the borrower's level of experience. We want to make sure that we prefer for them to have completed a couple of deals. We do not need them to have completed deals. Our preference is for them to have completed a couple of deals within the last 36 months. We want to know that they've done it before, but again, it's not a requirement. One of the things that we do differently than others is we look at what we call the 30% rule. So from a liquidity perspective, we want to know that borrowers actually have the means to get into these projects, the means to stay in the project, and the means to exit out of the project successfully. Our goal is essentially, hey, look, you have 30% of the total cost available to you. What does that mean? If you're buying a property for $200,000 and your renovation budget is $100,000, your total cost is $300,000. Our preference, not necessarily our requirement, is that you have at minimum $90,000 to get into this project. Again, that's not a requirement. That's more of a preference on our part. And the reason why we would like to see that is because of 4 reasons. Number one, you actually have the monies to get into the project. You have the cash to close. Number 2, you have enough monies to make a couple of monthly payments while the renovation is going on. Number 3, you have monies to start the renovation project, right? Because renovation loans, for anyone who's not familiar with them, you are reimbursed back the monies that you've already put in. So unlike a traditional mortgage where they're essentially going to advance you monies, we don't advance you monies. You're going to have to spend your money or your resources to get into the project. And then number 4, after you've satisfied the first 3, monies to close, couple months of monthly payments, and of course monies to start the renovation, we still need to know that you have monies to live. And so we do not want our investors to overextend themselves. Investors are ambitious people by nature. Sometimes that ambition is great. It's a great thing to have. Everybody on this call is ambitious. You guys could be anywhere in the world, but you guys are deciding, watching this, learning more about financing and STRs and BNBs. But we want to make certain that our investors don't overextend themselves. And then lastly, we look at credit differently than a conventional lender. A conventional lender is going to place credit as the very first thing that they take a look at, whereas we will look at the project first. And if we believe the project is a strong one, now we're going to take a look at other things such as liquidity, experience, location, things of that sort. But that's essentially how, if you're looking at a renovation project, and also this is very similar to a new construction project. We want to check this out. Well, this is very similar. New construction projects and renovation projects, very similar type of loan products. There are some major differences, but they're very similar. And so many of our clients will start off with a renovation project. They'll get an acquisition and renovation loan, and what they'll do, they will go ahead and actually, let me get out of this because I want to show you one last slide.
While you're switching that over, let me ask you a quick question about the liquidity requirement. Now, some of the investors and us included, when we're looking at projects, we may end up getting a secondary private money loan to kind of partner into that deal. And so if I've got, in that same example you just used, if I've got a secondary lender that I'm relying on to assist with some of the carrying costs that you talked about and basically the pre-funding of the construction costs before we get the draws, is that something that's acceptable in combination with what we might have in savings?
So this is where I start to sound like a politician. It depends. It
Right.
depends on the lender that you're working with. We are fine with that. Some lenders are not okay with that. Essentially what you're saying is there's going to be a second, and it also depends on if they're going to place a recorded second lien on the property, if they're going to record a second lien on the property. Some lenders are against that. The more institutional lenders, they are essentially, that's a big no-no. They will literally put that in their loan docs. There can be no second lien positions on this property. We are fine with that because we know investors, obviously real estate investors need to be creative. Even though in what does creativity look like? It can look like so many different things, whether you're partnering up with someone or whether you're getting a second source of capital. We do want to make certain that the folks have some skin in the game. But if that partner of yours is actually recording that lien, you got to be careful with that. You have to speak to the lender that you're going to work with to see if they're okay with it. And I would ask that question to the lender If you're not going to use Baker Collins, I understand. There's other folks out there. But if you're going to use another lender, ask them that question, because sometimes when people have done that, the lender finds out that the loan there has been a second lien that's been reported in this property, and then what they'll do is not a good day. So what they're going to do is, and we told you couldn't do this, you did it anyways, we're essentially going to demand that you repay us back this loan within 30 days. And that's not a good thing, right? Because now you have to go through the process of securing debt. So it just depends on which lender you're working with. Be mindful. Very, very good question. I get asked that quite a bit, but very, very good question.
Okay, cool.
Yep. So what I just spoke about earlier was essentially renovation loans and new construction loans. Our firm on the residential side, we offer 3: renovation loans, new construction, and lastly, rental loans. Rental loans, otherwise known as DSCR loans, these are a little different. These are renovation loans and new construction loans. In many times, we will sell that debt to Wall Street. We will sell that debt to big bond buyers. We will sell that debt, in some cases, to what we call debt funds. In many cases, with rental loans are always sold to Wall Street in every scenario, in every time. And the reason why I'm making that statement is because these loans are more sensitive to the market. These loans, there's not a lot of leeway here. There's not a lot of, with a renovation loan and a new construction loan, there are things that we can make up for. If someone's credit is a little challenged, hey, if they wanted to put a little more equity in the deal, a little more cash in the deal, we're fine. If someone has, doesn't have a lot of experience, hey, what they can do is they can add somebody to their entity that would allow them to kind of get the deal done. Rental loans, not as much. They're very rigid. And the first way in which we look at them is through credit. So with credit, it's a non-starter if your credit score is below a 660 for most lenders. Now, there are some lenders that will go a little lower than 660, but I would not recommend. I would rather you get your credit score above preferably a 680. 680, 700 is where you really want to be. Or you can add somebody to your entity if you decided to do that. We're going to look at the debt service coverage ratio. All that's a fancy way of saying how well will the property cash flow once we place debt on the property. That's all that means. You don't have to, it's obviously there's a lot more to that. I've oversimplified that, but all that means is once we place debt on this property, how well will it cash flow? Next, we're going to take a look at the as-is value of the loan, of the property. So we want to make sure that the property, the borrower, you are buying that property correctly. We want to make certain that you're not overpaying for this asset, because we do not want our investors overpaying for assets, because if they were to overpay for an asset, we look at every single deal through the eyes of a foreclosure. We have to make the assumption in every scenario that there's a possibility that this borrower could foreclose. And so we start with that premise. And if we have to foreclose on a property and you overpaid for that property and we have to take back that property, what have we just done now? We've essentially put ourselves in a really bad spot, because now we have a loan on a property that the loan is more than what the property is worth. That's not a good thing. We don't want to be underwater, right?
Right.
Many people remember, we as lenders, we are investors as well. Our investment is the note. The investor, the real estate investor, is the property. So we're very mindful of the note and how the note is created, how the mortgage note is created. That's what we're really focused on. Then, of course, market rent. This is where B&B investing becomes much different than permanent financing or long-term rentals become different than short-term rentals. Market rent, we do place a lot of weight on market rent. However, if there is evidence that we can have that there is an opportunity for the B&B investor to exceed that market rent, we'll definitely take a look into that. We will look into that and we'll see. This is one of the biggest differences between what short-term rentals and permanent rentals, the market rent. Because with short-term rentals, you're really looking at, you're essentially running a small business. In that small business, you have to factor in income, expenses. What is your income? Obviously, it's the daily rent that you're going to get, but then you have your expenses are almost on every time that property is turned over, and then little things like sheets and towels and things that sort of have to be constantly replaced. So this is kind of where short-term rentals and long-term rentals really differ, just this market rent. Then of course experience. We don't really place a lot of weight on the borrower's level of experience. We would like for them to have completed a couple of short-term rentals, but we really just want them to not live in this property. These deals are meant for folks who are not going to live in the property. The minute you live in a property is the minute you've essentially broken a loan covenant. And so we want to make sure people, but that's how we look at these type of deals.
Okay. And so let's say, I have some investors that acquire properties and then they hire a property manager. So in that case, you'd be able to look at the experience of the property manager, correct?
Yeah, we would definitely consider the experience of the property manager as well.
Got it. Okay. Now,
really
did you really prefer that it's the borrower that's the one that's running the short-term rental?
Well, no, we would love to see a property manager's level of experience, because that lets us know that there is a professional, this property is being professionally managed. And by it being professionally managed, that definitely helps us feel more comfortable in underwriting the loan and, of course, clearing the loan for closing.
Got it. All right. I don't know if you touched on this earlier, but on the new construction loans, can we talk a little bit about what's required there and what the average terms look like?
Yeah. So new construction, I don't have to go to the slide. So new construction was a loan product that was hit hardest due to COVID, right? New construction, one of the things we like to do is give you a longer loan term. Typically on a renovation loan, the loan term is going to be around 6 to 12 months. With new construction, we'd rather give you a 15 to 18 month term, because you don't know how long it's going to take you to get the number one thing you need for new construction, which is permits. In my opinion, the best way to acquire new construction is to buy the land, preferably with your own cash, or even worst case scenario with a private investor. Get your plans and permits fully approved through whatever municipality you're going through. While you're getting the plans through permit approval, you come to a group like us. We start the process as far as reviewing your deal, understanding what your price per square footage will be, understanding the lot size, understanding what you want to sell it for, things of that sort. We get everything set and ready for closing, but we don't close until you have those permits fully approved. That is the best way to do new construction. Because although we can finance a new construction project day one, if someone said, hey, look, I want to buy this land, I want to build on it, no problem. If you were to do that, we could close, but the thing about it is you have no idea how long it's going to take you to get your permits approved. It could take 1 month, it could take 6 months. But if you close when you acquire that land, you're still making you're accruing interest while you have our loans, right? So it's best to get the property get the permits fully approved, get the plans fully approved, work with us, and then once you have the permits in hand, it's approved, then you close. With new construction, because it is a riskier loan product, we lower the leverage, we lower the LTVs. And also with new construction, we are very sensitive to the borrower's level of experience. So one of the big changes post-COVID was now, because a lot of those municipalities that were issuing permits, they were working on skeleton staffs. And those skeleton staffs, they couldn't produce those permits fast enough. So a lot of lenders had to either, number one, refinance these 12-month terms that they had into 15 and 18-month terms, but a lot of lenders foreclosed on those properties as well. And so that just changed the commercial lending industry. So a lot of lenders, the lenders that actually are, and a lot of lenders have just kind of gotten out of that space because, again, everything is based off of risk and leverage, right? We look at every deal through the eyes of a foreclosure. If we as a lender have to foreclose on a property, it's easier for us to recoup our cash if it's a fix and flip. If it's a $40,000 to $50,000 fix and flip, the person foreclosed. No credible lender wants to foreclose on your property, by the way. But if we have to do that, we can send back some contractors and they can go ahead and finish the work. We can put it back on the market. It is a little bit of a loss, but we can still recoup something, get rid of the asset on our books, things of that sort. Compare that to a new construction project, and it's a slab, it's a foundation. And if we foreclose on day 90 in Georgia, 91 days, essentially you're going to get foreclosed on if you didn't make your monthly payments. If we have to foreclose on that asset, now it's a lot more difficult. Now we have to go find a contractor. We may have to get new permits issued. There's just so many more things that have to happen in order for us to get that done. And as a result, new construction is a lot harder product. But 85% loan to cost, essentially the borrower is going to bring best case scenario 15% as a down payment. In some cases, 20% as a down payment, subject to 70% of the completed value. So we look at two scenarios. Your cash to close is going to be a little more because we're giving you a lower loan amount because it's a riskier product. But new construction, the benefit of those, when you sell these properties, there's a little bit of a premium there because it's a brand new home. No one has ever lived there before. We are doing a lot of folks who are doing short-term rentals. They're building new, and there is this. It's not a new term, but to build to rent. So a lot of investors now are building for the intent of keeping a property, and a lot of the investors are keeping the properties for the sole purpose of short-term rentals as well.
No, that makes sense. And the build to rent is really kind of taken over, where you've just got subdivisions that are mainly for long-term rentals. We're seeing the same thing in the short-term rental space too, where it's build to rent for short-term rentals. So definitely very interesting. So the other thing that I wanted to touch on as well is the differences or the requirements for financing with multifamily. Let's say I have a 12-unit building, for example, that we formed a partnership to go after. What do the terms typically look like on that?
So again, I'm going to sound like a politician. It depends. Multifamily, is it a value add multifamily or is it a turnkey multifamily? So that makes a difference because number one, multifamily, I'm anal, multi-unit, 2 to 4 units, multifamily 5+, so that's definitely multifamily. But if it's a value add, if there's a construction component in any way, you're going to bring more cash to closing because it's a riskier play. And typically it's going to be approximately 15% of the total cost, 15 to 20% of the total cost. It's still subject to the completed value, but it's subject to the stabilized value. So a multifamily, if it's a value add project, we're going to give you at minimum a 24 to 36 month term because we know that you need more time to, number one, renovate the units. Number two, you got to put some tenants in there. Number three, you got to stabilize the asset. So therefore you can get to where it's 90% occupied over a 90-day time frame. Therefore you can have access to permanent financing. In many cases, permanent financing is going to be through Fannie Freddie. That would, in my opinion, Fannie Freddie is the holy grail of permanent financing. That's where every multifamily investor wants to be at if they can get it. Or worst case scenario, they can go to a local bank. Now, if it's a turnkey property, now it depends on how that borrower, the level of experience of that borrower, how well the property cash flows. Now you have a little more options. You can go Fannie Freddie, you can go conventional. If it's turnkey, depending on the level of experience of that investor, they can go up to 90% loan to value or 10% as a down payment. The higher the down payment, the more institutional that money is going to be. The more institutional the money will be, the more bureaucracy there will be with that monies. But the interest rate is going to be a little more attractive as well. So we can go off of, the SOFR. SOFR is essentially an index. It's a benchmark as to how we underwrite interest rates. The interest rates are going to be a lot more favorable if the property is turnkey. So it really depends on, number one, if it's value add. Number two, is it stabilized? Number three, what does the borrower look like? Can the borrower provide tax returns and K1s and The more information a borrower can provide, the better. I would recommend that our goal at our firm is to make certain that each one of our investors moves through the process of becoming a beginning investor to the point where they're a sophisticated investor, and not necessarily an experienced investor. I make a distinction. The beginning investor is just starting out. They are, if they've done maybe one or two deals. The experienced investor has probably done a good number of deals. They've just done a lot of deals, right? But then there's the sophisticated investor. The sophisticated investor has probably done a good amount of deals, but that sophisticated investor understands their KPIs, their key performance metrics. They have their accountant in place. They've got their bank run on speed dial. They've got their account, they've got all these things in place, and they have their tax. They have all these things in place. So when they have a deal, they're prepared for it. But they're prepared for permanent financing. They're prepared for short-term financing. They're prepared for intermediate financing. They're just prepared for these things. And the sophisticated investor is the one that's going to be able to really scale their business, because when they're raising capital, if they decide to do that, they can keep doing it. They can go out into the short-term rental space, and they can do that as well, because people want to partner with folks who are perceived to be sophisticated investors.
Most definitely. And for those of you that are not that familiar with the Freddie and Fannie, I mean, one of the main reasons to get to be able to do those types of loans is obviously the lower interest rate, the lower cost of funds. But more importantly, those are typically non-recourse loans, which is a big advantage as an investor. It allows you to scale your business, like you mentioned, and be able to go after larger opportunities. So.
Exactly.
So listen, Kenneth, I know we're a little bit out of our time here. I really appreciate you taking the time today. This has been very informative. For those of you that would like to reach out to Kenneth, if you've got a project you're working on, or you want to get more details and potentially look at some of the loan options that Baker Collins provides, I put his email address and his phone number down in the chat below. Feel free to reach out to him directly. I'm trying to work out kind of a special deal with B&B investors. But I think you're already doing something where you're not charging for appraisals. Is that right?
Yeah. So for the month of April, if you get a clear to close with our firm, we are going to reimburse you the cost of the appraisal. So there's a net no cost to you for the appraisal for the month of April. We are for your group and things of that sort. So just make certain that you do decide to call or email, let them know that you came you watched this podcast. To the podcast, or forgive me, I'm not on both. Okay. this show. Make sure you mention Rich's name so we can give you credit for that.
All right. Well, thanks again, Kenneth. I really appreciate it. It's been great reconnecting. I know Kenneth. I used to participate in some of Kenneth's live events and speak on some panels that he put together, and we just recently. Reconnected. So it's great reconnecting with you. I'm sure we'll be in touch in the future. And thanks again for taking the time. And thanks everybody for tuning in this week. Again, if you want to scale your business and learn more about short-term rentals, feel free to reach out to me directly. We can have a quick strategy call and see how we might be able to help you scale your short-term rental business. So thanks again, everybody. Thanks, Kenneth. And we'll talk again sometime soon.
Awesome. Thank you again.
Thanks for jumping on the B&B Investing Podcast this week. Please click on the subscribe and like button below. For more trainings, property tours, and content, you can join my B&B Investing Facebook group by clicking below. If you are ready to grow your short-term rental portfolio and maximize your monthly income, you can click on the link below to schedule a quick strategy call with Rich or someone from his team to see how we can help or point you in the right direction. Stay tuned for our next episode and hope to see you on the B&B Investing Group podcast.